Hey, listen, I quit. Yeah, I'm going into stocks.
Name of the game. Move the money from your client's pocket into your pocket.
But if you can make your client's money at the same time, it's advantageous to everyone, correct?
No one is paying attention. It's unbelievable.
Have to act now.
God, this is intimate. I feel like I'm financially inside of you or something.
Okay.
I have 5 houses and a condo.
I'm considering going long on April wheat. What do you think, Valentine?
Okay, so hi guys, welcome to this next lesson of the Professional Trader Program, lesson 2. So today we're going to look at a lot of interesting things. I'm not going to waste too much time, sort of introducing you to the lesson. Instead, we are going to flow straight into it. Now, of course, for those of you, if this is the first time that you're seeing this video, then we've had an introduction, which I highly suggest you watch first. And now we have a lesson 1 as well that we've done. So now we're on lesson 2. Now, of course, as always, the idea of the program is to ensure that I give you the fullest experience, or I give you the fullest training that will empower you to go on and become a successful investor, trader, whatever you want to call it. I'm taking 15 years of my experience, combining that and giving you this all for free, right? So that bit has to be important. And I've heard the saying that if you give people stuff for free, they don't value it and all that stuff. All I ask people to do, obviously in place of getting this for free, all I ask people to do is to give the channel a shout out, right? That's the most you can do. Share it with your friends, share it with people who want to learn, and I can guarantee everyone who's sitting here right now that they're going to get the best value they could have ever got, right? I don't care. You could have done like 1 million courses, or you could have done like 1 million stuff around trading and whatever, but you are not the information I'm going to provide you. You're not going to hear this anywhere else. Right? There are a lot of people doing a lot of teaching and mentorship programs and so on, but what I'm doing here, you're not going to see this anywhere else, right? And it comes from over 15 years of graft in both the professional and the retail space. Again, in my introduction, I've provided sufficient proof of what I do and my profitability, so it's there for you to see. Not really hiding anything from that standpoint. And I think it's important just so that you know that I'm more than qualified to talk to you about what I'm talking to you about. Now, people, of course, who follow this channel since 2015, 2015, you already know what I'm about. Some of you watched part of that journey on YouTube. And now I'm kind of here providing all this knowledge for you guys, all free of charge. Of course, there are going to be elements of this that are going to require a little bit more in depth, but I'm going to go as in depth as I can, given time constraints. Finance is a big topic, and if you want to be a professional trader, I'm not talking about the foolish stuff like get a few wins here and there. If you want to have consistency, that means that you're going to have to put the time in, and you're going to have to put the work. And what I'm doing here now is going to take a lot of your time. It's going to be hard. I'm going to give you homework to go and review stuff so you can actually go and have a look and see for yourself. You can go back. If I show you something on charts, you can go and verify online if you like. So I'm going to make everything as transparent as possible, but it's going to require your time. Anyway, enough of the rants. Let's step into this. So, carrying on from where we are, we're going to talk about assets. So, are all assets equal is the question. The answer to that is no. And this should get everyone to think about what do they want to trade. Like, everyone wants to be a trader. It's like, I want to trade. I want to learn how to trade. I want to learn. But what do you want to trade? Like, why are you trading the thing you're trading? So for some of you who are already trading, do you have any idea why you're trading cable? Do you have any idea why you focused on euro dollar? I mean, how is it helping you? Do you know where's your edge in euro dollar? Okay, I get it. You want to be a euro dollar trader. Where's your edge? Like, why? This, you know. So some of these questions are what I'm going to try and answer is why. Now, when I think about what I'm trading or why I'm trading it, there are a couple of things I'm taking into consideration. The first one is how much of an asset is available. Now, we all know intuitively the concept of demand and supply. So we know it intuitively at the back of our mind. We understand that if something is limited in supply, it tends to attract a lot of demand because there's not enough of it. And that demand is what pushes price up. So there's a relationship between price and demand, right? Any economist worth their salt will understand the concepts of elasticity of demand and elasticity of price, etc., etc. Right. So if we understand that concept, that price has a very close relationship to the demand, and vice versa, then we understand that we have to focus on assets that are limited in supply. Now, really good example to this is the latest craze in Bitcoin. And I did promise you guys that we're going to talk about crypto, but we're not going to talk about crypto in the way that you think I'm going to talk about crypto, right? So when we think about this, we think about assets like Bitcoin. There are only 21 million Bitcoin. That's it. There's only 20. It's a fixed supply. It can't be increased. So it's only ever going to be 21 million Bitcoin. Can you imagine how valuable that could be? An asset that is limited in supply, or has a fixed supply in this case, and it's not going to change. So there's no anticipation that there's a risk of a price change, right? Now, the only other thing you need to add to that equation is how interested the parties are in this asset, because if the demand starts to come in for that asset, then you don't have enough of it. You can't create more, so it gets more expensive over time, right? Because you can't make more. So, and when it runs out, it runs out, and people are going to be willing to bid up the price in order to get their hands on it. Now, this is not to say, of course, that Bitcoin is going to be the most valuable asset of all time, even though today, arguably, it kind of is, right? If you look at the price of one Bitcoin, I think as of the creating of this particular lesson, or as of the recording of this particular lesson, Bitcoin stands at about 37,000 Bitcoin. Now, think about it. Think for a second. How many assets do you know that's 37,000 at the moment? There is an asset that is worth more than Bitcoin right now, value for value, but it doesn't take away the fact that Bitcoin is limited in supply, and that is directly related to the price of Bitcoin today. And the volatility of Bitcoin is based on the fact that Bitcoin through time is limited. So those 21 million Bitcoin, they're not available right now. They're going to come into circulation over a period of time at a rate, right? So it's not just coming into circulation. The rate of introduction to the market is also being adjusted over 4-year cycles, right? So again, without going too much into the ecosystem of Bitcoin, and we're going to talk about assets individually, but I think it's important to see the relationship between the supply side of the asset, which no one focuses on, right? And again, don't take my word for it. When you go on social media or wherever, do you hear anyone ever talking about the rate of supply of Apple stock? I haven't seen it. I can scroll through my Twitter feed all day, and no one's talking about the supply of Apple stock, even though Apple has consistently bought back its stock, and in a way it's become a deflationary stock, which is contributing to the price of Apple today, which is roughly about $191 a share. And we're talking about a company that had a share price at one point under $1. So there's obviously a relationship between the number of an asset, how much of it is available, and of course the demand, right? So the question we always should be asking ourselves is, how much of an asset is available, right? So what's the overall supply of that asset? And that is largely going to contribute to how the asset behaves and how much money you're going to make. And I'm going to show you proof, right? So I'm going to show you what that looks like across different assets. So this point can be hammered home. It is not a changeable point. It is not a point you can argue. You just can't. It's not something you can argue about. It is not something that we can debate. It's not a debatable point. And so if you don't understand this factor, then you can already start to imagine, if you've been trading for some time and you don't know this, then you can actually start to see why it's been so difficult for you. Now, if you're new to this is exactly what I was aiming to do. It's to start you from the beginning so you understand things that people who were once in your position as a new trader obviously didn't get this information, and they wasted years, in some cases 5-6 years, going down a rabbit hole that was obviously, sadly, wasn't going to yield anything. It was just going to be very expensive for them. Now, the other aspect we want to talk about is the overall participant experience. I spelled participant wrong, but never mind. The overall participant experience. Now, you might hear this from an anecdotal point of view. Or you might have known someone who was maybe a very large trader in some pit or something that might have spoken about inexperienced traders being used as liquidity, or lots of other kind of weird stuff people say about people who don't have experience. Now, in mature markets, like or in assets that have a lot of maturity, i.e. they've been around for a long time. So if we take, for example, Apple, right? Apple's been a company that's been around for a long time, has a lot of liquidity. The participants in there tend to be a lot of professionals intermingled with retail traders and institutions, right? So people who just invest in Apple, to underpin their corporate treasuries, for example. And we'll talk about all of this stuff, don't worry. So any word that I use or any concept that I use, don't worry, I will expand on it at a later stage. So you will always get an opportunity to kind of really grind down and have that superior knowledge about what I just spoke about. So again, when we think about mature markets, the participants in there tend to be a bit varied, right? So as a result, you're going to see a lot more stability maybe in behavior, but you might not be able to generate as much return because those markets have become incredibly efficient, right? Because the players in there are now highly experienced. There's nothing to gain, right? So the inefficiencies are reducing. They're still going to be there, but they're reducing. The big participants develop technology that allows them to game that market more efficiently. Now, on the other hand, when we take an immature market, like we spoke about Bitcoin, we find there are not a lot of professionals in there. Obviously, now you're finding a lot more people getting involved, but because of the way Bitcoin works over the long term, it's highly predictable because it's an infant market. Obviously, as the participants become more experienced, the demand increases, liquidity becomes incredibly high, and you're going to find that at some point, it might not be as predictable, right? So the important point here is that if you get into an immature market or a market that doesn't have a lot of sophisticated players in there, then there's definitely a lot more opportunity. Now, again, don't take my word for it, right? Just Google on the internet. A good example would be the penny stock market, just in the 90s, the 90s into the early 2000s. right? Obviously that market was very, very attractive because there were professionals weren't in there. So it was just generally a lot of retail players, and what you used to get was a lot of promotions or promoters who promote these stocks, and they go really high, and then everyone would just line up to short them because everyone knew they were going to zero, right? And we'll talk about what shorting means and all of that stuff, right? But basically what I'm saying is that people used to just wait for these markets to rise and then just sell them back down. So it was a very profitable game. But then the institutions realized that, well, you know, a lot of these penny stocks were, you know, they were not in on regulated exchanges, right? They were like in pink sheets and exchanges that were questionable. So the people who were controlling this were not finding that it's going well for them. It wasn't profitable. You know, a lot of brokers will go bankrupt. So they figured out a way to make more people lose money in that market. So they became more sophisticated. And then they created algorithms and things that would, and then after a while, it wasn't really profitable. There was no arbitrage there. So many people left that market, and then they focused on other markets that maybe weren't as advanced, right? They didn't have that level of sophistication. So they found other opportunities. So again, this is something I think about when I'm thinking about what to invest in. And this could be applied to, let's say, even larger companies, like so let's say you're a stock trader and you know, everyone buys Apple, Nvidia, you know, these are well-known companies. But let's say I pulled a company out of my head, like Badger Meter Inc., right? BMI is the ticker. So go look it up, right? And then tell me what the rate of return has been on that asset over the past, say, 5 years, right? So I'm just making an example here, right? There's no recommendation or anything like that. It's just an example. So you can start to see that this might not be a company that everyone is talking about, right? Yeah, I mean, I'm sure half the people listening to this now never even seen that company. But then on the flip side, you look at the rate of return, it's pretty high, right? And that's also, in my opinion anyway, is because it's not something that everyone's watching, right? So the only people who are in the know that have a certain experience around that are going to get involved, which allows me as an investor to be able to judge. So if I see a lot of activity in that particular stock, I'll be more inclined to show an interest, right? Because I know that a lot of people aren't watching this, so whatever's going on here has to be based on what insiders, or you know, people we like to call insiders, know, and the action is based on maybe proprietary type information. Now, I know some of you are going to say, but isn't insider trading illegal? Yes, it is, but it doesn't mean people don't do it, right? And again, like I said, don't take my word for it. I believe there's a documentary. You should be able to find it online. I can't remember who did it. It's one of these documentary channels that is focused on Stephen Cohen. Now, of course, I don't know the guy. I have no idea, but there's a documentary out there suggesting that, you know, certain people around his circle were arrested for insider trading. And this is probably how a lot of them managed to stay profitable. It's public knowledge. It's out there. Everyone can go and watch it and see it, right? So my point is that because you think that something doesn't exist or is illegal, doesn't mean it doesn't happen, right? It does happen. In this business, a lot of things happen that shouldn't happen, but they happen, right? And that's kind of the takeaway from all of this, that you want to assess your market based on the level of sophistication in there. Is it a mature market? How efficient it is, and so on. I'll show you how to do that, right? And I'm going to show you some examples today as a precursor, and I'll show you exactly how you determine all of these things. So to answer the question here, all assets are not equal, right? So that's the important thing we want to take away from this. And that means you have to be selective about what you decide to trade. Now, as always, the proof time. So here you're looking at GameStop. Now, I deliberately picked this one because I know everyone knows about GameStop. Now, this was a company, or this was a stock that was trading around about here. Now, of course, remember, this stock has gone through a stock split and everything else at some point, so the pricing scale is not really reflecting. I think it had a 4-to-1 stock split at one point. So let's say on average, this stock was trading roughly about $3. Right, so it was roughly about $3 when the market took an interest in this. And the rate of return, if you're looking at this, was 18,000% from the COVID lows of 2020. Within about a couple of months, right, it was trading near enough pre-stock split price, and we'll talk about what stock splits are, but we won't get there yet. Pre-stock split price, I think it went to something like $400 a share, right? 400 plus, right? And you can see that from the price. Now, why did this happen, right? Everyone thinks it's because, you know, what they say on the media, and there are movies made about this, and if you've seen the movie Dumb Money, then you probably already know what this story is all about. But reasonably, yes, the stock did this, but it did this, it had the ability to do this because it had a lower float of shares, right? So the amount of shares outstanding in this company, right, so the share float, the number of shares available for people to purchase, was actually really small. And also there were a lot of people who were borrowing the shares to short them. So when the price started to rise, right, which was the premise of the whole GameStop, is that beyond a certain point, the people who were short, unfortunately, was just one institution, really. It wasn't really a company called Melvin Capital. And again, that's public knowledge. So if you go out there and you research this story, and I implore you to, because it will really send the point home. And Melvin Capital was the only one short this particular stock, or at least short in the number, or the volume they were. So when these retail investors, had gotten together on Reddit, Wall Street Bets, and they started this financial revolutionary movement, and using GameStop as their vehicle, started to buy into the company. It pushed the price up, and those people who had borrowed those shares to sell them short with the hope that this company is going to go to zero and go bankrupt, found themselves needing to buy back all those shares that they shorted in order to cover their short positions. And we'll explain the process of this a little bit more in depth in future lessons. But the point is that these guys were now in the hole, for several billion, I think to the tune of about 6 or 8 billion. And basically the company was on the hedge fund was on the verge of bankruptcy, right? And obviously they turned to one of the largest high frequency trading firms on Wall Street called Citadel to save them based on their own connections to Citadel and so on. And Robinhood, who was the main intermediary or the broker, found themselves in the middle of it all because a lot of the buying was happening on their platform, and it caused their liquidity providers to request they put more cash up to fulfill all of these trades, right? Because these people were buying this, but however, Robinhood didn't have enough money for when they sold, when they took profits, right? So they needed to be able to have on-hand liquidity based on the number of people that were buying it. And that caused Robinhood to stop everyone buying the stock. So unless you'd already bought it, you couldn't necessarily buy any more. And that obviously put pressure on the stock because, again, the stock was very high and there's no more demand. So they restricted the demand side of the equation. So obviously the price started to drop quite rapidly. Obviously, Congress got involved because obviously it seems like market manipulation, right? And as a consequence, it was a whole string of hearings, including some of the retail traders had to go give evidence in Congress to show that weren't manipulating the stock higher. And then obviously Citadel had to go give evidence to Congress that they weren't manipulating the stock lower, and so did Robinhood. Right? In the end, it all centered around Robinhood because they refused to give people access, and a lot of Americans would have viewed this as problematic. Right, so that's the story around this stock, and that's why I brought it up. But what I wanted you to see was that the number of shares available on the stock can definitely influence how far that stock travels. So especially if people start buying it, they can quickly push it up because there's not a lot of shares anyway to start with. And the people who are shorting it can easily get squeezed out of it because they've borrowed a lot of shares. And if the owners of those shares start to request them back because the stock is going higher, then these people have to go find it at whatever price to return it to them, right? Because it's not their stock. They borrowed it, and the owners were happy to collect interest from them in the same way when you go borrow something, money in the bank, you pay interest. So it was the same thing. So anyway, long and short of it, you can see the amount of return here. Robinhood and GME or GameStop is it's a weird example because it doesn't happen every day, but I can certainly show you others where that share supply causes an exponential rise in price as long as the demand is there to come in, right? So that's one example. It's GameStop. So again, if you were someone who was primarily hunted or follows this theory of, I'm going to focus on stocks that have lower float and have potential, where there's potential for demand, then you're going to have quite good results. So now let's compare that to, say, the British pound and the Japanese yen, which if you're a forex trader, everyone will tell you, that pair moves. All you have to do is just wait in, you're going to get hundreds of pips, and it's like a very exciting pair, right? So that's the name of the game. Over the same period, that GME made thousands of % return because of its lower float. You can see that the British pound over the same period only made 26%. So that's why leverage is essential in these markets, because unless you're in a leverage position, which exposes you to a lot of risk, you're not going to make much money being long the British pound versus Japanese yen. So these markets attract a lot of leverage, sadly, because everyone wants to make money, but they're not really considering what they're trading. They just want to trade something, and the brokers want people to trade these things. So they try and create the conditions that would attract people to come in and trade them, so they can ultimately make some money themselves. So yeah, it's perverse industry, guys. Sorry you have to hear it this way, but it's just the way it is. So if you look, these currencies are highly liquid. There's so many billions of them flying around everywhere. The currency market has a 4.8 trillion turnover on a daily basis, right? So the amount of cash that changes hands in dollars is 4.8 trillion. It's actually a 5 trillion market. So the additional 200 or so million is all foreign currencies, right? And they turn over this on a daily basis. So it's a big business currency, and that makes it highly liquid, and that restricts its movement. Not to mention it's linked to geopolitical conditions, it's linked to the dollar, so there's a lot of politics in here and a lot of central bank intervention. So currencies are kind of limited in terms of what they can do. So if you're really looking for return, or you're looking for power plays, like we just saw in GME, you're not going to be a currency trader, right? So one of the reasons why a lot of people will stay away from currency is because it has you need to have a lot of leverage, which makes it high risk, and you don't get a lot of return. So you have to amplify your return with leverage, which means that if the market goes against you, you can very quickly find yourself completely wiped out, right? And so that's some of the danger that exists with currency. So it encourages people to trade these things with a lot of leverage, and also trade them short term, because as you can see, the longer term volatility is like 26% basically over the same period that GME did crazy numbers. But if you look at the way the candles are set up here between the bull days and the bear days, you can see that there's a lot of spiking and moving around, and that's intraday volatility, right? So this is a 1 month chart. So you can clearly see that over the long term, without a high degree of leverage, it might not have been profitable for you to trade the Japanese yen. At least it would have been profitable, but it wouldn't be you maximizing your return. When you look at a chart like this, it's very obvious. I mean, how could you not make money? But no one wants to trade a monthly chart, right? It's clearly obvious. And when we start getting into technical analysis, you would have seen quite easily how easy you could have made money trading these things. But for most people, it's not enough. I mean, who wants to hold a currency for 5 years? Right? And when you understand a lot about CFD trading and some of the costs associated with it, you're probably not going to do that. You're not even sure about your counterparty's solvency over 5 years. So, who would do that? So that's some of the challenges you find with leveraged assets, and especially those that are traded in the CFD world. Right, so here again, there's another proof that it's not that you can't make money trading currencies. That's not what I'm saying. I'm saying is that it is not maximizing the amount of money you can make. So you have to take a lot of leverage, which exposes your capital to depletion. Right? That's just a fact. Right? And that's why I said I'm going to show you a lot of proof, as we go through these sessions, because I don't want people coming back and saying, but I know a guy who makes X amount, and what you're saying is, no, look, just go do your own research. And I've pulled up the charts, I've done it, but go check it yourself, right? So you won't say I drew these charts. Go check it yourself. So here we see crude oil, West Texas, WTI, West Texas Intermediate. So we see WTI crude. Now, again, you can see the return for crude over the same period, COVID. Now, of course, to be fair, we had a big incident with crude where crude went negative on the futures. On the spot CFDs, didn't quite go negative. It was on average about $8. But if you're trading the actual futures, you were literally paid for the oil contract, right? So some people made a lot of money who were able to buy oil much lower. So if you looked at that as a rate of return, it was 947%. So it was about a 9x return. But that's not really fair. Not many people would have had the foresight to buy oil at $8, right? Especially with what was going on in the markets. However, it's reasonable to say that people could have purchased oil at $20, right? And as you can see, if you'd done that, it was still a 5x return over a similar period, right? So if we're calculating that against, to sort of 2022, it was a stellar return, right? That's long before anyone started to think about, Russia, Ukraine, or any of that stuff, right? So again, it just goes to show that when we think about commodities and we think about the rate of return, it's a lot higher than, say, Forex as an example, but it's not as high as, say, what we've reviewed, which is crypto. So you can see that obviously it might be better from a trading point of view, maybe to trade commodities as opposed to Forex, because obviously you get a better return. So it's nothing personal against Forex. It's just you get a safer return. I wouldn't say safer, but you get less risk associated with your return, and that's evident from the rate of return. Again, but if you look at this and you look at the price scale, what's the likelihood we're going to get that kind of rate of return again alongside? We might want to short crude oil and get that rate of return to the downside, right? But usually when you're dealing with commodities and stocks, they can only go to zero. And because we know crude oil can't go to zero, it is what it is, right? You carry more risk to the upside. Whenever you're going short something, you carry more risk associated with it, especially when it's something that has a dollar denominated amount. So again, there's the proof that obviously commodities have higher volatility, therefore a much more interesting consideration for someone who might want to do this kind of swing trading, for example. Let's take a look at small cap stock, right? So again, when we think about these things, we have to think about them in terms of how much of an asset is available. Now, we call these low float small caps because the number of shares outstanding is very low. It's very small. I mean, this company doesn't even make any money. But people are interested because the float's really low. This stock traded all the way to $1 from roughly about 2022. So imagine you were long this stock at 22. I mean, you pretty much lost all your money. Now, of course, if you were selling this stock short, you made a lot of money on the downside, i.e. whatever you sold short. And this is the other thing that no one ever tells you, is that when you see all these posts on social media, and I should have put actually some screenshots of that up here, so you can see what some people say on Twitter and social media about shorting stocks, and they create all this excitement. But what they don't tell you is, well, yeah, when you're looking at this now, it looks great. You shorted at 22 and it went to $1.23. It looks good. But let's say you shorted 100 shares, right? You were up for $2,200, right? And if that stuff had gone up, let's say the stock had gone up to $28 a share, then 100 shares would have meant that you're already out of pocket for $600. Let's say it had gone to 34. Right? You get the point. It keeps getting worse, right? Soon you're down for $1,000, 2, 3, 4, 5, 6. Your losses now become unlimited. You become Melvin Capital, and everyone else is Wall Street bets. You know, that's not a good place to be. And that's some of the dangers that come when you're shorting a stock. So while it might be exciting, is that, well, look at the downside. I know some of you are saying, yeah, but this kind of stocks, all you do is short them. You never buy them. You look at the downside. Well, think about it again. The float is really low. This might not even be a profitable company, but for people who their primary focus is these very low price stocks, they're going to be looking for certain pieces of information on these downsides for them to buy. Now, arguably, if you are buying at $4, it's a problem, you know. But again, some people might anticipate that there's going to be a reversal. And there are things you can look for, and I'll teach you this. I'm not going to get ahead of myself, so I'm deliberately being vague as to what people look for. But there are things that you're going to look for that are going to give you an idea this thing might rise. Now, the other thing I want you to look at is that this stock dropped 26 points. Right, so it was a 95% clean out, right? Because remember, if you sold it short at 2,200, it went to zero, then you keep all your you get $2,200, right? And that's great. You know, depending on, let's say you were willing to risk $2,200, then you made 100% return. Now, on the flip side, let's say you'd bought $1,200 of this at $1.23. This thing went well, today it's showing at $8.69. So it's decent return as well, equally, right? So $1,200 meant that you had in your bank, in your brokerage account, $8,690. You don't have to be a mathematical genius for you to think that actually I could have lost, you know, all of my $1,200, but on the same token, I didn't. This is how much money I made. Now, if I'd shorted $2,200 a share, so, you know, using my brain, I'm like, do I want to short any more? Probably not, because I could lose everything. Then I really only ended up banking $2,200. That's it. That's all I made. So shorting things encourages you to do that leverage thing, right? Because you're borrowing money. Anytime you hear something that says you borrow, it just means that you're putting yourself in debt in order to take advantage of an idea. So now you borrow this money and you've leveraged. What if it goes the other way? Whilst, you know, this stock can only go to zero, right? It doesn't matter. It can go that way, but it can go to zero, and that's it. You lose $1,200. Now, again, if you took leverage, let's say you did 4 times that, still $4,000, you could lose $4,000. But then again, you can make $32,000. So the risk to reward on the long side, you know, is a little bit better. Right, while the risk on while this is a higher probability trade, because obviously the company isn't making much money and it's trading a little bit high, so it looked like a higher prop trade, but on the same token, it was high risk if it didn't work out. Whilst this didn't look like a high probability trade, but it was very low risk, and if it worked out, you get significant upside. Right, so that's kind of how a lot of people view the market. It's really a question of understanding your risk, like what's higher risk, and no one talks about this stuff. Yeah, everyone's talking about risk management, but no one's actually talking to you about how do you assess risk, right? So again, there's the proof that when something is limited in supply, there is a tendency for people to come and suck all that supply, and then you get these parabolic moves. Is it always the case? Is it always predictable like this? No, it's not always, but every now and again you're going to find opportunities, maybe in profitable companies with lower floats, that are going to allow you to have this kind of return, right? And there are a couple of those too. So I guess we'll call that homework, right? Is go home, look for companies with lower floats, share floats outstandings, low prices historically, and see how far they've traded, right? That's a good back test for you, so you can see some of the potential that people chase when we think about floats. Right, so again, taking another example, this is Marathon Digital. So Marathon did a 238x return, right? 238 times your money, right? So again, this stock was trading around about sort of the 34-cent mark, traveled all the way up to just over $50. Now, this was the float. It was 5 million shares. That's all it was when we started this ascent. So you can see how quickly it got squeezed upwards, right? So even though it was really cheap, you know, maybe you didn't think about it at this point, but certain conditions happened that might have alerted people that this stuff is going to keep rising because the float is really low, and there was clearly a lot of interest in Marathon around about that sort of 2019, 2020. So again, this is off the COVID lows. So you can see here 238, and I'll explain to you guys why this is the case, why this happened across the COVID lows, right? So why was COVID so significant with all this growth? And I know some of you are going to be thinking, God damn, why did I not see this? Or, God, is that how much people made, how much money was made during a time when the world, entire countries were struggling? They were in lockdown. Some people lost their jobs. Now, how many people would have changed their lives if they understood about the stock market at the time? Right? It would have been a life-changing event for a lot of folks. Some of us, it was the best time of our lives. Right? But then there were a lot of people who it wasn't. They just didn't, they had money. They had lots of it at the time, but they just didn't know what to do with it. So they sat down and felt sorry for themselves and engaged in the politics. And, this time is gone. This was a generational wealth transfer that will never occur again. It's the reality of it. So you can see that there were a lot of people taking advantage of this, and within about a year, this is the kind of money that was being made. Yeah, and that's because of float. Now, just to prove, and again, like I said, we're going to be like, low float, but that's not the reason. There was this fundamental information that came out, and this is why, and all that bollocks. Like, guys, trust me, it's got nothing to do with that. So let's take a look at where the number of shares outstanding is today. Right, companies lost even more money. They've printed more shares to keep their business operation. It's sitting at $10. 138 million shares now outstanding versus the 5 back in 2019, 2020. So I'm going to ask you guys, do you honestly think, right? And before we even go into that, the first quarter they sold $36 million worth of stock onto the market. We'll talk about that at some future point, how companies can sell stock on the market. So it's 130 million shares now outstanding. Do you honestly think that this company is going to 10x again? You really believe it's going to do a 238x? Not going to happen. Even if it went all the way back to 50 cents, the chances of it trading back up here is incredibly slim. We would need another world-ending event for that to happen. Sadly, it was an opportunity missed. If you weren't in this, you just weren't. It's life. It's done. It's gone. With 130 million shares, 38 million shares outstanding, this thing might go back to 28 cents, even less. The next time it peaks, it might only peak at $1 or $2. Right? The game has changed, right? And you can see how the increase in shares is going to impact the price action for the future. Now, unless, of course, the company does something amazing, they start turning over a profit, which you can gladly see they're not, then it's reasonable to think that this company is not probably going to go back to those highs. It's just a thought, guys, and it's something that I think everyone should think about. It's possible. It might do that. It might go up there. Who knows? But I'm pretty sure it won't stay there, even if it does. And even if it does, it's still just a 5x return. The chances of you getting a 238x return is now gone. All right, let's take a look at something again that's really interesting. This is GBTC, right? So it's Grayscale's Bitcoin Trust. Now you can see here at one point, this trust was down at 26 cents. If we go back to the 2016 Bitcoin cycle, it did a 169x return, right? It's 169 times your money before selling off. And then in the prior cycle, it did a 15x return. Today, it's doing a 3x return, whilst if you were owning Bitcoin, like you were actually buying Bitcoin this year, you made about 100% year to date, right? So you doubled your money if you bought it at the low. But on the same token, if you'd bought GBTC, you're making 3 times your money relative to the 100, the 1 times your money by owning Bitcoin. Now, this brings me into an interesting topic, which is ETFs, right? Which is what GBTC is. It's an ETF. The market in the crypto market has been screaming for a physical Bitcoin ETF, right? GBTC is standing as to be one of those, right? It's OTC at the moment. It's not traded on a major exchange. So when we say OTC, we mean it's traded over the counter, and we'll talk about that. But for now, let's just go with the fact that it's not on a major exchange because the Bitcoin ETF is not being approved by the SEC. So at this point, the only people who have access to this, and this goes back to my point of participant experience, right, are institutional investors. So unless you were an institutional investor, you probably can't buy GBTC on your brokerage. So this means that the people in this market are largely professionals, institutions, and they're not going to cheat each other, right? Because they understand this asset is asymmetrically heading upwards. So they know that as long as they're buying the dips at the end of cycles, there's a high chance of profit. So now thinking about this, where do you think GBTC is going to be in the future by the time we get to the end of the next Bitcoin cycle? I kid you not, it could easily be $100 a share. And imagine the people who've been holding it till 8. They're going to make a phenomenal return, right? So the business, right? So again, this goes back to when you want to understand fundamental arguments. Should we have an ETF that everyone can buy? Really, I don't care. Because in truth, if you can buy GBTC, for example, then you're going to make this kind of return anyway, right? And that's what people care about, is return. So if you ask my honest opinion, I'll tell you that the future of Bitcoin is in ETFs. Because who's going to want to pass up this return in favor of buying a physical Bitcoin ETF? So unless there's going to be some additional value in owning your own Bitcoin, which I believe there is, then we might see two pricings of Bitcoin. Like maybe Bitcoin price your physical Bitcoin at a higher premium, and then we might see this ETF stuff priced at a slightly lower. And obviously this is the case because you can see the ETF is like $8 at the low, right, versus to buying one Bitcoin. So there's going to be a lot more attraction in these things, but that's going to change the number of shares outstanding because the demand is going to grow. Even though it's going to be mirrored a lot with Bitcoin, you can see it's a high volatility. It could easily just mirror itself to Bitcoin as the share float increases. So I guess you guys are getting the point that it's really important to look at these metrics when you want to decide what you want to trade. So to that cardinal point, what should I trade? Well, for me, assets with low supply goes without saying. Now, of course, if you think, I know some of you are going to be like, oh, I don't know, I'm not sure. What? I have showed you so much proof. The kind of stuff you're not going to see anywhere else. I mean, who's trying to show you proof that you should be buying assets with low supply? I mean, they're trying to tell you should buy X, Y, and Z. And if you look at all these things, there's nothing about them that suggests that their supply is low. Right? And don't tell me about NVIDIA. Right? Don't tell me about NVIDIA. There's a reason you don't want to tell me about NVIDIA, because NVIDIA is a large cap stock that's making some serious innovations, and the demand in that was going to be so high from institutions who are going to have NVIDIA in various different portfolios in various sizes. So the demand for NVIDIA went up, and that priced into the stock really quickly. Is NVIDIA going to go to 1,000 a stock? I don't know, but I don't think so. Right? So it might do in the future, but then they'll just do a stock split. So in reality, don't quote NVIDIA, right? Because obviously the demand for NVIDIA really spiked, and that's also relative to the supply. It might not have a low supply, quote unquote, but what's better? Ask yourself, should I not just buy something with low supply with the view that it's going to get squeezed and spiked up? Well, yeah, probably should. Right? So low supply is important, especially when it's not factored into the price. Demand and supply, guys. That's all there is to say. Immature markets, absolutely. We've already made the proof with Bitcoin. Immature market. GBTC, immature market. That immature market is closed off to a lot of people, but it's an example of an immature market. So I had to put it on there, right? And just to go to show you how sometimes the powers that be will prevent retail people from getting involved in these things just because they feel that they want to have the money for themselves, so they restrict you. Highly volatile assets. Well, we've seen that with Bitcoin. Extremely volatile price moves, and you tend to get that with assets with low floats. We saw that with GME. So they offer the best risk reward. But the moment this metric changed, as we saw with Marathon, stops being an opportunity. So for me, these are all factors. They kind of feed off each other, right? But they're factors you want to look at when you want to decide what you want to trade. So the question remains, do you want to be a Forex trader? Now, I'm not saying if you traded Forex in the past and you did well, great. But knowing what you know now, what do you think is the best asset you'd like to trade with your limited information that you've got at the moment, just from the little you've learned? That's a question you should be asking yourself. What would I like to trade? What feels good to me? Where do I think my next big move's going to be? And that's how you're going to construct your portfolio. Right, so let's grind this down to some homework. Go and check tradingview.com. It's free, right? Because that's where you're going to be able to find all this charting stuff. So that's the first thing you got to do. Go to tradingview.com, sign up. It's free, right? At least get a free version. I think it gets ads and stuff that pops up, but it's no big deal. And then if you want to go pay for it, then pay for it. Next exercise, pick a stock over $50, pick a stock under 5, pick a commodity, gold. I've shown you some examples already. Pick crude oil, pick Bitcoin, and finally pick 30-year treasury bonds, right? And I like you to measure from the lowest price to the highest price from March 2020 and write down in dollar terms how much a $5,000 investment would have yielded over the time had you invested it at the absolute low. Now, I'm being totally unrealistic. Not many people have invested the absolute low, but the point I'm trying to make is that by looking at each of those assets, what do you think you would want to trade based on historical performance? And also, while you're at that, make sure you check, right, what the overall supply of these things are, right? So find out how many commodity crude oil futures are out there. The information's there, guys. I'd love to tell you, but I think it won't do you good, because then you can go and find the proof on your own, right? See how many of these are available, right? And then compare that to the rate of return. And then come back to me and then tell me what you think. That's it. So I hope you guys have enjoyed this lesson number 2. Now, again, like I always said, structure these things in sort of way to hold your attention, right? And if you're waiting and you're trying to tune off or trying to watch that funny guy, if you're trying to watch a Mr. Beast video, and the same, it's what it is, guys. You're not going to be able to do this. So it makes sense that you're weeded out, and then the people who are still watching, you're on your way to greatness. That's all I can say. Because that's part of it, is just understanding. This is the very beginning, and I promise to take everyone. I don't care your level, is that you start from the start, and I walk you through everything you need to do, so that you can start this journey. So hopefully you enjoyed lesson 2, and if you're still here, like I always said, you just got to subscribe. Most importantly, I'm going to maybe not put these all out at once, so they're going to be coming over time, so you might want to hit that notification bell so that you know when one of these is going to happen, so you can continue learning. Beyond that, just subscribe, guys. That's it. That's the best. It's free, right? That's the best you can do for the channel, so it helps others. I mean, for me, I don't care. I've had this channel since 2015. I have just a little over 3K subscribers. I don't have 100,000 subscribers, so I really don't care. I can survive without it. So, it's not that kind of thing. So by spreading the word, you're helping others, and you're helping everyone overcome what might have been a life challenge by getting an opportunity to do this. Like I said, what I'm going to show you guys here and talk to you guys about, you're not going to hear anybody else. I mean, it's detrimental for some of the guys out there today who are teaching. They're going to look at this and think, oh my God, we got to kill it in the cradle. In any case, guys, have a fantastic weekend, and see you on the next lesson.
Hey, listen, I quit. Yeah, I'm going into stocks.
Name of the game. Move the money from your client's pocket into your pocket.
But if you can make your clients money at the same time, it's advantageous to everyone, correct?
No.
No one is paying attention.
It's unbelievable.
Have to act now.
God, this is intimate. I feel like I'm financially inside of you or something.
Okay.
I have 5 houses and a condo.
I'm considering going long on April week. What do you think, Valentine?